Learning objective 5 is specific operating expenses. We're going to look at general ones and then bore in on two items that are often confusing or complicated. Let's look at some very typical accounts that you would see as far as expenses. The first is cost of sales, and this is what does it cost you to produce or purchase from others that product that you just sold to your customers, right? The cost of goods sold. Second is selling, general, and administrative. And these are things like marketing, salaries, rent, insurance, just normal things it costs you to run the business. Research and development, we'll cover this in more detail, but that's for the cost of doing research that you're doing to pursue your next generation products. Third is amortization and intangible. This is similar to depreciation, but they're intangible assets that go down in value. Next are restructuring charges. So this is where the company has made a decision to move out of its current core businesses and move some of the items off, and those are restructuring charges. And these would be layoffs or plant closures, things like that would be restructuring. Next would provision of taxes on income. And so the word provision, just think of the word expense. So when they say income tax provision, think of it as income tax expense. And these could be federal, state, or international income taxes. Next would be discontinued operations. Again, we'll look at this in more detail a little bit later, but this is when a company has decided to exit a line of business. It must show that as a separate set of line items on the bottom of the income statement. You cannot mix it all together, and again, we'll talk about this in a moment. And finally, income attributable to non-controlling interests. That's a mouthful, but what it means is a company buys another company, but it didn't buy all of the other company's stock. So there's some hangers-on that are we call minority interests or non-controlling interests. Now we have a problem. When we're presenting the statements to our shareholders, we don't own everything. So we have to have a provision that we have to subtract out the part we don't own. All right, back to R&D. So we broadly have R&D covering salaries and benefits for the people that are on staff to do research and development, and supplies that they use in conducting research. Let's say it's a pharmaceutical, all their reagents and chemicals cost money. Next is licensing fees. They may use some sophisticated software or other technologies from other companies, and they paid for that, so that needs to be expensed. And then third-party payments for collaboration. So we may pay for some research assistance from labs on universities, etc. Those are expenses. And we have equipment. There is some equipment that may be specific to use for this type of exploration. And finally, they have facilities, physical space like labs or office buildings to do the work. That has to be expensed. So this is all the types of money spent to pursue research and development. All of these are expensed as incurred except for the PP&E assets, which we can capitalize and depreciate. We would expense 100% of salaries, 100% of licensing fees, and 100% of the third-party payments. But lab equipment, that's going to be usable for, if not this lab, maybe another lab. We could capitalize and depreciate it over the life of those assets. Analysis. In our analysis of R&D, we start with measuring R&D as a percent of total revenue, just to give us a sense of things. For example, if a pharmaceutical spends 12%, that means for every dollar of sales, we spend 12% of those sales for research and development. We saw last week that Intel spends a lot of money in pursuit of new products and new technologies. We would look at that and then benchmark it against two things. One is its recent past, so look at the last 3 to 5 years and see is that trend going up or down. It shows their level of commitment and investment. Secondarily, compare one competitor to the other. If you're looking at pharmaceuticals, compare Pfizer with Merck or Schering-Plough or Bristol-Myers, and just see who spends a higher percent of the sales. My main caution here is that just because a company spends money doesn't mean they're doing good things with that money, right? They can waste money as well as anyone. So just because one company wastes a lot of money, it shouldn't be rewarded by us thinking that they're committed to R&D. It's really hard to measure the quality of their expenditures, but we could certainly measure the quantity. So we start with that and then we keep going. Then we will look at things that are more forward-looking, like what do we see that might impact the future. So we'll look at what products are coming out in the pipeline and see what that's going to be worth. In pharmaceuticals, you might look at the entire life cycle, what they have in R&D that they're now moving into clinical trials to test on animal and humans, and then how far are they in getting approval from the FDA to allow that drug to be sold in the United States. And then ultimately, once they have it, then we could then say how long, if any, do we have patent protection, so no one can reverse engineer our pharmaceutical and make it for just the cost of the ingredients. This is how analysts look at it, not only the dollar amount or the percent of sales, but the quality of their pipeline. Discontinued operations, as the name sounds, sometimes we may have many businesses. Let's say a company has 20 businesses and wants to get out of one. If we didn't do any special accounting, we would mix in all the revenues with the revenues from the other 19. We'd mix in all the expenses for this discontinued operation and mix it in with the other 19. Now, if it's tiny, who cares, right? It's very small, won't change your mind. But what if the company has gotten out of a major line of business that comprises a substantial amount, let's say a quarter or half of a company? It does happen, not commonly, but can happen. So in that case, you definitely want to separate out the revenues and expenses from the discontinued operations. And then we put it all on the bottom in one line representing how much do we make or lose in running the business, and those are the operating side. And then once we are able to sell it to somebody who wants to buy that line of business from us, that would then finalize with a gain or loss from selling that business. So those are the two lines. One line, the operating profit or loss. The second line, when it's sold, gain or loss from the sale of that discontinued operation. Now, it's net of tax because in the order of the income statement, we have revenues minus expenses, get to operating, minus taxes, get to after tax. And this would be below, again, to show it separated from all the other things we do for continuing operations. Why do we segregate it? It's because it's a transitory item. As mentioned, if you got rid of a major line of business and somebody's using your statements to project into the future, you want them to know that so they don't count that because it's gone. This deals with a phrase that's quite important. It's recurring and non-recurring items. McDonald's selling hamburgers, that's a recurring item. They're going to keep selling that. But let's say McDonald's got out of the taco business. Well, that's a non-recurring item, so get rid of it. You may not know this, but Chipotle used to be owned by McDonald's. They did sell that at one point. Okay. And then next are the transitory. The phrase transitory means it comes and goes. Those are another example of things that we as analysts want to identify and consider when we project into the future. These types of discontinued operations tend to be not little things like, oh, let's close a store that's not working well if you were Walmart. No, this is like a strategic shift out of a line of business. So it can't be just little things. It has to be a pretty major decision by the company.